The advantages and disadvantages of technical analysis. The advantages of applying technical analysis to the market are: first, it is applicable across all markets, instruments, and time frames where price patterns, oscillators, and overlay indicators are all treated in the same manner. No new learning is required to trade new markets or time frames, unlike in fundamental analysis where the analyst must be conversant with the specifics of each stock or market. There is no need to study the fundamentals of the markets traded, since technical analysis believe that all information that impacts or potentially may impact the stock or market is already reflected in the price on the charts. Technical analysis provides a clear visual representation of the behavior of the markets, unlike in fundamental analysis where most of the data is in numerical form.
It provides timely and precise entry and exit price level preceded by technical signal indicating potential bullishness or bearishness. It has the ability to also pinpoint potential time of entry via projection techniques not available to fundamentalists. Fundamental analysis does not provide the exact price or time of entry. It makes the gauging of market risk much easier to visualize. Volatility is more obvious on the charts than it's in numerical form. The concerted effort of market participants acting on significantly clear and obvious price triggers in the markets helps create the reaction required for a more reliable trade.
There are 5 disadvantages of applying technical analysis. First, it is subjective in its interpretation. A certain price pattern may be perceived in numerous ways, since every bullish interpretation is an equal and opposite bearish interpretation. All analysis is susceptible to the possibility of interpretational ambiguity. Unfortunately, all manners of interpretation, regardless of the underlying analysis employed, be it fundamental, statistical, behavioral, or equally subjective in content and form. A basic assumption of technical analysis is that price behavior tends to repeat, making it possible to forecast potential future price action. Unfortunately, this tendency to repeat may be disrupted by unexpected volatility in the market caused by geopolitical, economic, or other factors. Popular price patterns may be also distorted by new forms of trade execution that may impact market action, like automated, algorithmic, or high frequency. Program trading, where trades are initiated in the market based on non-classical patterns. Third, disadvantages. Chart provide a historical record of price action. It takes practice and experience to be able to identify classical patterns in price, though this skill can be mastered with enough practice. The art of interfering or forecasting future price action based on past prices is much more difficult to master. The practitioner needs to be intimately familiar with the behavior of price at various time frames and in different markets. Although classical patterns may be applied equally across all markets and time frames equally, there is still an element of uniqueness associated with each market action and time frame.
It is argued that all market action is essentially a random walk process, and as such, applying technical analysis is pointless as all chart patterns arise out of pure chance and are of no significance in the markets. One must remember that if this is the case, then all forms of analysis are ineffective, whether fundamental, statistical, or behavioral, since the market is primarily driven by perception. We know that the random walk process is not a true representation of market action, since market participation react in very specific and predictable ways. It is hard to believe that price action is the result of random acts of buying and selling by market participants, where the participants are totally unencumbered by cost, biases, psychology, or emotion. The last disadvantages of technical analysis. The strong form of efficient market hypothesis, or EMH, argues that since the market discounts all information, price would have have already adjusted to the new information, and any attempt to profit from such information would be futile. This would render the technical analysis of price action pointless, with the only form of market participation being passive investment. But such efficiently would require that all market participants react instantaneously to all information in a rational manner. This presents an insurmountable challenge to EMH. The truth is that no system comprising disparate parts in physical reality reacts instantaneously with perfect coordination. Hence, it is safe to assume that although absolute market efficiency is not attainable, the market does continually adjust to new information, but at a much lower and less efficient rate of data discounting. Therefore, technical analysis remains a valid form of market investigation until the markets attain a state absolute and a perfect efficiency.